Most people never become wealthy for one simple reason. They think they need more money before they can start, more income, more savings, a better job, a bigger opportunity. So they wait. And while they're waiting, something incredibly valuable slips away. Time. Here's the crazy part. You can build a surprisingly large investment account with an amount most people spend without thinking. Just $100 a week, not $1,000, not $10,000, just $100. But what happens to that money over the next decade is where things get interesting. Because after 10 years, you're not looking at the amount you deposited, you're looking at what time did to it. And that's where the story changes. Let's use a simple example. Historically, the S&P 500 has averaged about 10% annual returns over long periods. Some years are amazing, some are painful. Nothing is guaranteed. But for this example, we'll use 10%. Now imagine you invest $100 every single week. No fancy strategies, no stock picking, no trying to predict the market, just consistency. Over 10 years, you'll personally contribute about $52,000. Sounds decent, but here's the part most people don't expect. Your account could end up somewhere around $90,000 to $100,000, maybe more if markets perform better. Think about that for a second. You put in $52,000, yet you could end up with nearly double that. Where did the extra money come from? Not from working weekends, not from a side hustle, not from some secret investment trick. It came from compounding. And compounding is far stranger than most people realize, because at first, it feels completely useless. The beginning is actually the hardest part. After your first year, you've invested around $5,200. You check your account. Maybe it's worth $5,400, maybe $5,500. That's it. A whole year of effort for a few $100. Most people see that and immediately lose interest. They expected fireworks. Instead, they got boredom. And that's exactly why most people never experience the real power of investing. They quit before anything exciting happens. The first year isn't about making money. It's about building proof. Proof that you can stick with a plan. Proof that you can stay consistent when results are small. Every week you invest the same amount. When markets rise, you buy fewer shares. When markets fall, you buy more. Simple. No guessing, no stress, no trying to outsmart Wall Street. And while it feels like nothing is happening, something important is quietly taking place. Your earliest dollars have already started working. They're beginning to earn returns. Then those returns start earning returns. That's when the snowball begins rolling. Year 2 feels different. Not dramatic, just different. Now your balance starts growing a little faster, not because you're investing more. You're still investing the same $100. The difference is that your money has a larger foundation to grow from. This is where people start realizing a powerful truth. Small actions repeated for a long time become surprisingly large outcomes. By year 3, something shifts mentally. You open your account and notice it moved up even on weeks when you didn't add anything. That's a strange feeling. For the first time, your money is helping carry the load. You're no longer doing all the work alone. And that's when investing becomes addictive. Not because you're getting rich, because you finally see progress. The numbers are still modest, but now they're moving in the right direction. And confidence starts replacing doubt. Then years 4 and 5 arrive. This is where the gap begins to widen. You've been doing the exact same thing every week. Nothing changed. Same contribution, same routine, same boring habit. Yet suddenly your account starts growing by thousands of dollars. Not hundreds, thousands. And here's what makes it fascinating. The growth is no longer coming mostly from new deposits. It's coming from the money already inside the account. Think about that. The dollars you invested years ago are now creating new dollars. And those new dollars are creating even more dollars. The machine is starting to wake up. By year 6, the process feels completely different. A 10% return on a small account barely moves the needle, but a 10% return on a much larger account can create several $1,000s in growth. Same percentage, completely different outcome. Most people misunderstand compounding because they focus on the rate. The real secret isn't the rate, it's the size of the base. The bigger the foundation becomes, the harder compounding works. And now something incredible starts happening. The gap between what you've invested and what you actually own begins growing rapidly. This is where investing finally becomes visible, not theoretical, not something you read about, something you can actually see. Then comes year 7, and this is the turning point almost nobody talks about. Until now, your weekly deposits were doing most of the heavy lifting, but around this point, your investments begin contributing almost as much as you do. Read that again. Your money starts working nearly as hard as you are. That's when the entire game changes, because once your investments can generate thousands of dollars a year on their own, momentum takes over. The system begins feeding itself, and your job becomes incredibly simple. Stay consistent. Don't interrupt the process. Just keep showing up. By year 8, the math starts feeling almost unfair. You might still be contributing around $5,200 per year, but your account could be generating more than that by itself. Imagine having a coworker who never sleeps, never complains, never takes vacations, and works 24 hours a day. That's essentially what your investments have become. The money is now creating more money than you're adding, and that's a powerful shift because every dollar earned can now produce future earnings too. This is where compounding goes from interesting to impressive. Year 9 accelerates even further. The numbers begin growing at a speed that would have seemed impossible in year 1. Back then, making a few $100s felt like a victory. Now your account could generate thousands of dollars in growth in a single year, without increasing your weekly contribution, without working extra hours, without changing anything. Same habit, different outcome. And that's the lesson. Success often looks slow right before it becomes obvious. Most people only see the obvious part. They never witness the years of quiet progress that created it. Then year 10 arrives, and this is where everything finally makes sense. Over the decade, you've invested about $52,000, but your account could be worth somewhere around $90,000 to $100,000, maybe more. That means tens of thousands of dollars were created simply by giving your money time to grow. Time did the heavy lifting. Not effort, not intelligence, not luck. Time. And here's the uncomfortable truth. The people who quit during year 1 never see any of this. They walk away during the slowest phase. They judge the process before the process has a chance to work. The boring years create the exciting years. The invisible growth creates the visible growth. Without the early stage, the later stage never exists. Which brings us to the biggest mistake of all: waiting. Many people tell themselves they'll start investing next year, or after a promotion, or after they feel financially ready. But every year they delay comes with a hidden cost. They lose something they can never recover: compounding time. And unlike money, time cannot be replaced. You can earn more income, you can get another job, you can rebuild savings, but you cannot go back and invest 5 years earlier. That opportunity disappears forever. So here's the question: 10 years from now will arrive whether you invest or not. The calendar doesn't care. The clock keeps moving. The only thing you control is whether those years work for you or against you. And remember, $100 a week breaks down to roughly $14 a day. For many people, that's a forgotten subscription, a few impulse purchases, a couple of delivery orders. The real obstacle isn't always money. Often it's hesitation. People think they need confidence before they begin, but confidence usually comes after taking action, not before. The market doesn't reward people who waited until everything felt perfect. It rewards people who started. Start small, automate the process, choose a broad index fund, ignore the daily noise, and most importantly, give the system enough time to do what it was designed to do. Because one day you'll wake up, look at the numbers, and realize something surprising. The habit that felt tiny changed your entire financial future, and you'll either be grateful you started today or wishing you had. As always, this is for educational purposes only and not financial advice.